indicated, I work for the U.S. Small Business Administration. We do a number of different things, and one of the big things that we really do is we help businesses obtain access to capital. So that's really my area of focus at the agency. But because I do work for the agency, I do need to quickly mention some other things that we do. We work with government contracting. We help small businesses obtain government contracts. We have an advocacy group that lobbies at Congress to talk about different things that affect small businesses, and they lobby to try to help improve regulations. There's a lot of regulations in government, and as a federal agency, I see the regulations all the time. So there's folks that are constantly trying to get things through the process and make things easier for businesses. One of the other big things that we do, and we partner with organizations such as SCORE to do this, there's a lot of entrepreneurial development, so education, training, technical assistance. SCORE is one of our partners that does that. But kind of back to the whole reason that everybody's here, small business funding, how do you get it and where do you get it? Sources of capital, what lenders look for in a loan applicant, and that would be the 5 C's of credit, and we'll go through each of those 5 C's in detail. What a credit score is and why it matters, particularly why it matters to a lender. And then what's included in a loan application. We'll talk a little bit about the importance of a business plan, cash flow projections, and the assumptions to those projections. And again, these are all things that the SCORE counselors that are here can help you with. Where to get money for your business? Well, the first place you're going to find the money is basically in your own pocket. So it's money that you've saved. Any lender is going to look to see that you have some money into the project that you're looking to fund. You could get money from an investor who might share a piece of the business. Money that could be given to you from family, friends, and then money that you borrow personally. Home equity loan, credit card. I don't encourage you to use credit card for a variety of reasons. You can get into a lot of trouble trying to fund your business with a credit card. Interest rates are pretty high. It's a recipe for disaster. But money that you borrow through a business loan, you have a bunch of different options. You have the traditional options, which would be banks and credit unions. There's special programs and non-traditional lenders that are available as well, and this is kind of the umbrella where SBA guaranteed loans fall within. You have mission-focused lenders. Department of Commerce and Economic Development, Department of Agriculture has programs that lend money to businesses, not just agricultural businesses. And then CDFIs, which Vermont Community Loan Fund is one as well. So there's all these sources, and then that you can borrow from, and then there's other potential sources. I'm only going to touch very lightly on this because this is not my area of expertise, but I believe one of the sessions SCORE will be covering a little bit more in depth in the area of crowdfunding, peer-to-peer lending. So something like Kickstarter, Indiegogo, and then there's credit-based peer-to-peer lending, which would be like the Lending Club, Funding Circle, Prosper. But really, my recommendation is don't necessarily look to those things. There's lots of places to get capital. And I think if you establish your business and you've built a relationship and you're borrowing that money, long term, that's a really good thing for your business. So getting a business loan, what does a small business owner need to bring to the bank? Where do you start? Well, I always say, where do you have your deposits, right? Start with where you have your bank deposits. Go in, introduce yourself. All the institutions have lenders. all the credit unions, all the banks, they all have lenders. And while the mission-focused lenders can do certain things, one of the things that they cannot do is they cannot take your deposits. They're not set up to be housing your money. So I always recommend start there. Just go in, introduce yourself, just so they get to know who you are. They're going to be upfront with you if they can lend to you or can't lend to you. And 9 times out of 10, if they cannot lend to you, they're going to direct you to another organization where you can obtain that financing. So what do you need to know about traditional lenders? Everybody's heard the jokes about the banks, right? They're cold-hearted bankers. They don't want to lend money. Well, the truth is they exist to lend money, and they don't actually make any money unless they lend money. They don't make a whole lot of money on your deposits, right? I mean, everybody pretty much has a checking account, right? I don't know what you're getting for a return on the money that would be sitting in your checking account, but it's probably not much. So it's the same thing for the bank, the credit union. They're not making any money unless they're lending money. The thing is the banks and the credit unions, and even the mission-focused lenders to a degree, they're all regulated. They're all the things that they're doing are being looked at, right? So there's certain requirements that they have to follow. They report back to the shareholders. So again, they want to lend money, but you've got to have certain things prepared, and then certain institutions, quite frankly, just only lend in certain areas, or industries. But that doesn't mean you wouldn't be able to get a loan, because then there's mission-focused lenders that would be considered a potential opportunity for you. So what do you need to know about what would be considered a non-traditional lender? So this is loan sources other than the banks and the credit unions. I know I have credit unions on here. There are some credit unions that are a little bit different. So in that they are mission focused, and they are out there trying to help specific businesses in the community. So you've got your banks and your credit unions, and then you have a couple of mission-focused credit unions in Vermont as well. So I kind of lump them in with the non-traditional lender group, because they're making loans to businesses that the regular banks and credit unions just won't touch, even with an SBA guarantee. You've got your microlenders, you've got your community-based lending programs, and then there's another program that, and VCLF has access to this program. SBA has what's called a Community Advantage program, and it allows them to make loans that they otherwise might not make and get an SBA guarantee on it. Then you've got your online lending platforms, which are open, 24/7. Be very careful with them. Interest rates that I've seen that they charge are traditionally a lot higher than what you could get locally. So kind of at this point, Dan's going to talk a little bit about what a microloan is, so you kind of have an understanding of that.
All right. So when we're talking about microloans, we're talking about loans up to $50,000. That's the maximum. In my experience, we've lent on everything from loans as small as $5,000 or smaller, all the way up to that $50,000. But the advantage for us as a community development financial institution for using a microloan program is that it allows us to offer what in the slide it calls technical help and advice, but also business advisory services is what the term I like to use for it. And what that is it allows us to, if particularly for newer entrepreneurs, to bring someone in, not to run your business for you or anything, but to be another pair of eyes to look things over and give you a different perspective. Because in our experience, when you're running a business day to day and you're putting all of those hours in, sometimes it's helpful to have someone come in and offer a perspective from a different point of view. As part of microloans, in terms of what you would use a microloan funds for, would be things like working capital. So basically, when we say working capital, we're talking about covering operating expenses while the business builds up and grows. We're talking about funding inventory, supplies, equipment, etc. But with the SBA microloan program, it is not for acquiring real estate or refinance of existing debt. And so I'll just jump on down to what matters most to lenders, if you don't mind. And so, speaking from our perspective, what we're looking for is someone who is knowledgeable about the business and is willing to put the time in. That's the most important thing. So one of the first things I'm gauging when I'm talking with someone for the first time about their business is, one, what their experience is in that field. Is it something they sound like they have a passion for? And also, next, is it something that is going to be able to make enough money to pay the bills? We're talking about cash flow. Are you able to pay all the expenses of the business, including any debt payments that the business has, and still have enough, one, to pay a salary for any owners or operators, and two, be able to provide something that the owner considers successful at the end of the day? And so, in regards to how we try to manage the risk of lending, collateral is a part of that, and collateral can be anything from the assets of the business to a co-signer who has outside assets that they might be able to pledge if it's a startup business. And is there any thing the business owner can do to put in anything up front to help put some skin in the game?
So just quickly before I move on to the 5 C's of credit, we've kind of thrown out like all these different places to get money. So kind of on the spectrum of where everything kind of lies, you've got the really bankable stuff, which goes to the banks and the credit unions. The banks and the credit unions also use SBA programs, and we have programs that they can finance working capital, inventory, fixed assets, equipment, real estate, those types of things, and we have a whole variety of programs. Those institutions will look to those programs when there's something that isn't quite up to what their standards are, and SBA allows them, by getting that guarantee, it allows them to then turn around and finance something that they might not be able to finance. And then, you kind of down the line, you've got mission-focused lenders and the such. So, and again, they have access to a lot of the SBA programs as well. So as we go through kind of the 5 C's, think about your business or think about what you're looking to do in business, because you're going to put together a business plan, and these are things that you want to encapsulate in that business plan because the lenders are going to look at them. So the 5 C's, character, capacity or cash flow, collateral, capital or your contribution, and then conditions. So those are the most common things that the lenders are looking at. The first C, character, that's your personal reputation, right? That's the who. And, what do they look at to figure out the who? Well, they'll look at where you've lived, how long you've lived there, or are you constantly moving around? Again, they're looking to try to figure out different things about you. Again, if you have an account at the bank, they're going to look at your account. Do you overdraw your account? Or, is your account handled as, it's supposed to be? They'll look at how you pay your bills. So they're going to pull a copy of your credit history. Now, if you have bad credit, that doesn't necessarily mean that you can't obtain a loan.
Yeah, let me jump in here. So in regards to credit score, one of the most common questions I get asked when I'm talking to someone seeking funding for their business is there a specific credit score that I have to have, is what I'll be asked. And the answer is we do not, at Vermont Community Loan Fund, have a set credit score that we cannot lend above or below, but we do run the credit report, we do look at it, and what we're looking for in regards to credit score is if there are adverse events on the credit score, we want an explanation as to why it happened and how you're going to avoid that in the future. And if you starting getting really low on the credit score, we still are going to try to find a way to get to yes. That's one of our principles is when we're talking with business about funding is see if there's a way for us to get to yes. But in order to do that, if there's something really negative on the credit score, we need to know why it happened, how it's going to be avoided in the future, and also is there something compelling about your mission of your business that you're doing on a mission perspective that we could allow us to mitigate some of that risk from a mission perspective. When I talk about things we're looking for on mission, I'm talking about are there Vermont jobs being preserved or created? Is it supporting Vermont's working landscape, and that's agriculture, farming, logging, those sorts of things? And lastly, is it supporting and preserving Vermont's downtowns? In practical experience, oftentimes where we're finding impacts is in preserving and creating Vermont-based jobs. But so there's no set credit score that we look at personally, but we want to understand what's on the credit report and why. It's a data point for us.
Mm-hmm. So kind of in that same light, lenders hate surprises. So we always recommend you pull a copy of your own credit report. It's free. You should be doing it every year. I don't know the exact number of the slide, but I've included in the presentation the www.annualcreditreport.com. You can obtain a copy of your credit report. It doesn't affect your score when you pull that credit report once a year for yourself. But go through it. Make sure there's nothing in there that shouldn't be. The credit reporting agencies aren't perfect. So there are times where things show up that maybe don't belong to you, or maybe it's something that you paid off and the vendor didn't clear it off. At least you know what's in there, because the lender is going to take a look at your credit report, and you want to be able to speak to it if there is anything in there that's adverse. Again, just a simple explanation. But again, that's speaking back to your character, right? If you're upfront with them and you tell them, oh, I have this on my credit report, you give them the explanation, they're probably going to go to bat for you. If you have something adverse on there and you don't tell them and you say, no, my credit's fine, and they pull your credit report and there's something on there, then that doesn't say good things about your character. So they're going to ask. So pull it, know what's in there. So kind of what is the FICO score? And again, kind of how does it get calculated, from the good and the bad? So it really is it's a complex algorithm, but basically what it looks at how much credit you have available, how much money you owe on that credit that you have available, and then it looks at how much money you make. So and there's some complex algorithm that looks at it, so you could potentially have no credit and have a bad score because you don't have any credit established. So again, something to pull and take a look at. Again, the lender will look at that very closely. They'll look at, that's how they determine if you're paying your bills on time, because they're using that credit report to determine that. They'll look, if you've ever had bankruptcies or any types of judgments. One thing that comes up frequently, and I get a lot of calls from folks looking to borrow money, they may have had a medical circumstance, and it's sitting on their credit report, and they're fighting with the medical folks on payment of it. Again, just explain that to the lender. But again, if you don't pull your credit report, you don't actually know what's out there.
Yeah, in terms of things that hurt people's credit scores, the most common ones I see are medical bills, issues with student loans, or if there's family adverse circumstances like divorces or recent deaths in the family. Those are the common things we see that hurt people's credit scores.
Oh. So the higher the score, the more likely it is you're going to get a loan, because the lender perceives that to be less risky, right? Because they're looking at how you handle your current obligations, personally. So, that's one of the things they're going to look at. It's one of the key factors that they're going to look at. There are some lenders in the state that, for loans under $250,000, that's all they look at. They just pull your credit report, and that's it. They run it through a system, the type of business that you are, and they pull your personal credit report, and they decide, yes, I will give them a loan, no, I will not give them a loan. So it's very important that you look at it. So if your credit score is low, again, look at it, report mistakes, contact the creditor in writing. There are different things that you can do to try to get them to correct it. And let the lender know that you've been trying to correct what's on your credit report if there are things on there that don't belong on there. Sometimes you may have a name that's a common name, and the data gets crossed. Or they're pulling from an address, and maybe you haven't lived there for a long time. There's a whole variety of things that it pulls from. Identity theft is very common now. Again, that's another reason to make sure that you're pulling that credit report. It's just so common. I know personally, working for the federal government, my information was stolen. So I had to close out a lot of my accounts because all my information was out there. Again, if there's outdated things on there, you'll want to get those fixed. Sometimes you may have had a credit card a long time ago, and sometimes they don't actually close it out. It still may show on your credit report as open credit, even though you don't even have the credit card anymore. So again, that's something that could potentially impact your score because they're looking at what you have as available credit. So first thing I would do is pull your credit report. Can't say enough about that. So the second C of the 5 C's is capacity and cash flow. And that really comes down to, does your business generate enough revenue so that you can pay your obligations and then pay the loan? And that's called cash flow. So there's certain calculations that the lenders are going to do based on information that you provide them as part of your business plan. They have calculations where they like to see more than 1-to-1 coverage, right? So by that I mean, once you've paid all your expenses for your business and you've got your loan payment, they like to see that you can cover that. Typically it's 1.2 times.
1.2, yep.
Yeah. 1.2 times is kind of the trigger for them. So when you're going through and working with your counselor, make sure that you understand that. It's because the banker or lender is going to take a look at that to make sure that that's where you kind of fall. They do a lot of ratio analysis, and that's one of the things they're going to look at.
Yeah, I'll expand on this because the ratio is important, but also what's important is our goal as a CDFI is to give people the opportunity to try to achieve their goals through their business, but at the same time, we do not want to overextend people, and so the easiest way for us to overextend someone is to lend them more money than they can afford to pay back through the course of the operation of their business. And so that's something we constantly wrestle with as we're working to underwrite loans. And one common question we'll get from people is, I'm generating so much money through my business, but I also have this outside stream of income unrelated to my business. And while that can certainly be very helpful, our goal as a mission-based lender is to, whenever possible, see that the revenues of the business are able to operate the business and pay the debt. So we do consider sometimes outside streams of income, but far more important to us is to see what the business itself is doing.
So we kind of have two groups here. We have existing businesses and we have some folks looking to start up. So as an existing business, you're going to have financial statements, tax returns for the business, right? So the lender is going to look at those historical numbers, and that's how they're going to figure out, based on a historical basis, they could have paid the loan. So that's what they'll rely on to determine that cash flow. If you're a startup business, they're going to rely on your business plan, and you're going to put together projections as part of that loan package that you put together, and they'll rely on the projections. So this is an area where SBA does a lot of work. We work with a lot of startup businesses because that's an area where the lenders perceive there to be a lot of risk. So, and rightfully so, because you're relying on projections, right? And that's just an educated guess on, how much revenue you're going to actually generate. So they'll look to use our program to help them provide the financing.
Yeah, in regards to financial projections, we lend to startup businesses. Financial projections we find to be a valuable tool, at least for the first year of projections, and it can be a useful exercise for a business owner or a potential business owner to run projections out for a couple of years after that, but at that point it really becomes of much more limited utility. Though I will say we do give more weight to projections that have been prepared in context with either someone who has a lot of industry experience or who's used another agency to help prepare the plan, like SCORE or some of the various other agencies throughout the state.
So the third C that they're going to look at is collateral. And as part of collateral, I like to say collateral/guarantees, because of all questions that I get from folks, it revolves revolves around personal guarantees. Folks don't, for whatever reason, they don't think that they should have to provide a personal guarantee. The lender, yes, they consider that secondary collateral. Primary collateral will be the asset that you're financing. They will take a first position lien on that. And then if you own 20% or more of the business, you've got to personally guarantee it. There aren't very many lenders out there that are willing to lend on an unsecured basis. There's probably only a handful of companies in Vermont that I'm aware of that have those kind of terms. It's just, it's the lenders consider it skin in the game, right? You got to provide your personal guarantee, to show that you actually stand behind your business. So I know I get that question all the time. Well, I want to get a loan, but I don't want to provide a personal guarantee. Well, that's a non-starter. Personal guarantees are pretty much required, just a non-starter.
Yeah, I'll echo all of that, and I'll also say that in regards to collateral, while it's something that's important to us and we value it, seeing the cash flow of the business, which we talked about previously, is we give more weight to, but there does need to be collateral there. There does need to be a personal guarantee, and for the reasons he said, and also just when we're talking about lending to small businesses in Vermont, we're basically talking about usually 1 to 2 owner-operators, 1 to 2 people. So it's about us getting comfortable with you as a person and seeing that you're willing to sign your name to it and make that level of commitment.
So the other thing, the lender's ultimately looking to secure their loan, right? So they're willing to lend you the money, but at the same time, they're also thinking, how do I get out of this if they default on the loan, right? And that's what they're looking to. They're looking to the collateral. So the other thing around that, if you own a residence and you're light on collateral, they will look to take a second mortgage on your primary residence if you have equity in your home. It's not that they're going to take your home should the loan go bad. Again, it's not like they're going to come after your personal guarantee. There are instances where they do, but if you're willing to work with the bank or credit union or lender, if the loan does go sideways, they're going to work with you to do whatever they can to make sure that you get out of it in the best light.
What I'll add to that point is that if we understand that when we're lending in the space we are of supporting small businesses, loans can go bad. That is part of the risk that everyone is taking. What I will also say is that as long as you're willing to continue, I'm speaking solely from my organization's perspective and mine here, as long as you're willing to continue to work with us, even in an adverse circumstance, and you continue to be forthright and honest with us, we'll find a way to work something out. It's when people start being evasive and deceptive that we start to run into problems rather quickly.
So the fourth C is capital and contribution. So you kind of look at this in two different ways. This is your contribution to the project, okay? So kind of ties back to the collateral because they're not going to finance 100% of what it is that you're looking to do. So you need to have some funds to put into it. Standard is going to be anywhere from, depending on the type of business that you are, existing, startup, it could be anywhere from 20% to 25%. I know there are some business owners that have had to put in 30%. It's going to vary depending on the lender, the institution that you're working with, and what it is that you're looking to do. So again, that's kind of your contribution to the project. SBA. Any SBA product that the lenders use, we like to see that there's some sort of equity contribution into the project. One of the things that we used to allow that come January 1 that is changing, if you were purchasing an existing business from somebody, we would allow the seller note to count as equity if you got a seller note from the person that's selling the business, in addition to your other loan funds. SBA has now decided that that's not really your own money going into the project, so they've kind of pulled that back, and that is a regulation change as of January 1. So our advocacy group took a look at that, and they're working with Congress on it. So there may be some other changes down the road on that. But again, it's your cash coming into the project. It could be borrowed. There are ways to do it as borrowed. So you could use a home equity line of credit, borrow against your primary residence to put the funds into your business.
Yeah, I will add here that speaking as a CDFI, even if you have limited funds of your own to put in or no funds at all, we can still try to look at doing something smaller to see if there's a way forward. But obviously, that we need other factors in your business or your proposal that are compelling.
So the fifth and final C is condition. And this is really the conditions that the lender is willing to lend to you within. So that is the loan amount, the interest rate, what you're actually using the money for. Is it real estate? Is it equipment? Is it working capital? and then they'll take a look at that, and that's what they'll say, this is what the business can afford based on all of the other factors. They'll look at the economic conditions of the market that you're in, depending on what it is that you're doing as a business owner. So there's a variety of different things they'll look at. Again, this is another area where lenders will look to use SBA programs. We allow them to extend terms beyond what their normal underwriting guidelines allow them. So, for instance, if you were to be financing a piece of equipment and you went into a bank or a credit union and they said, we'll lend you the money, but we'll only lend it to you over a 5-year period. Well, that has a huge impact on cash flow, right? 5-year loan. SBA programs would allow them to go out to 7, possibly even 10, depending on what it is. So you'll have a lower monthly payment. It's just stretched out over a longer term, which can be very helpful to a lot of businesses.
Yeah. What I will add here is that in regards to the length of the term of a loan, from my perspective, it's very hard to go on a length of term beyond the useful life of the underlying collateral. So if you're talking about a piece of equipment that in 5 to 7 years it's going to be fully, depreciated and used up, it's hard to give a loan term beyond that length. So one common question I get is, why are the length of terms offered such as they are? And that's the explanation.
Mm-hmm. So standard length of term, just so people know, working capital as a line of credit, which is something that you borrow and pay back, they typically will extend that for 1 year, and they'll do an annual review every year to make sure that you're handling the line the way you're supposed to. So you're borrowing and paying back, borrowing and paying back. If you borrow the money right up front, like month 1, and you're unable to pay it all back during that year, they'll convert it to a term note so that you're paying it back, and they'll arrange, for a specific period of time that you make monthly payments to pay that money back. So traditionally, it's a 1 year thing with an annual review. If they use an SBA guarantee, it's a 7-year product for us, but again, they'll still do that 1 year review, and as an internal process for them. Term loans, generally, they run the gamut of time. Again, kind of tied to the useful life of the equipment. Could be anywhere from 1 year up to 15 years. That's pretty much the standard. And then real estate will be anywhere from 20 to 25 years. And it won't go beyond 20 unless they're using some sort of guarantee, either a USDA Rural Development Guarantee or an SBA guarantee. Again, that's a flexibility that the guarantees allow them.
Yeah.
Just a word on that. The guarantee actually is to the bank or the credit union. It's not to you as the borrower. So and basically the way it works is it works as a deficiency. So if you default on the loan and they need to collect on the loan, they'll liquidate all the collateral, and then whatever is a remaining balance, they'll get a percentage of that back from the federal government. So it's not to you. We get a lot of calls from folks saying, I want to get an SBA loan. Well, I used to, but I don't do any lending anymore. SBA doesn't actually do any direct lending. Now that I said that, though, that's not entirely true, because one of our divisions does do disaster loans, and that division does do direct lending. And right now, with the disasters that happened in Florida and Texas and Puerto Rico, where we have teams mobilized, and they're out actually doing direct lending. And not only do they lend to businesses, but they lend to individuals as well. So if you remember Irene, there was a group here that was doing lending to individuals and businesses during that whole. So at this point, we're at the prepare to ask for a loan. It can be intimidating when you're going in and you're sitting down and you're saying, I need to borrow money. It's key, just be prepared. Tell your story. Your business plan's going to lay that all out. Make sure you understand what's in your business plan. Make sure you understand how much money you need, how you're going to use the money. Again, they're going to have questions, and those are some of the questions that they're going to have.
So I will give one important piece of information here. When a lender asks you how much money you're looking to borrow, it's good to have a general idea. The one answer you should never give is, I'll take as much money as you can give me. Well, there are a couple reasons for that, and one of the ones is that means you haven't thought through what your business can afford to pay back. So that's an important tip I'll leave you all with there.
Yep. And that actually is one of the slides. How will you pay the money back? Again, so kind of have an idea of how you're going to pay it back. If you're working with a SCORE counselor, they're going to go through like your projections and your business plan and all those types of things with you. So you're going to understand your financials, and you're going to understand how you pay your bills. And again, one of the other slides, how much money should I ask for? Well, really, you should ask for what you need. So that's something that you need to figure out. So business plan. I've mentioned it a number of times. It's a very critical document as part of your loan application. It not only helps the lender, but it should be a roadmap for you as a business owner to follow. And, again, it's a document that provides the lender information. A lot of folks have all their information in their head, right? Getting it down on paper provides something for the lenders to look at, to get an understanding and to really know what it is that you're looking to do. As part of the business plan, you're going to have financial information, and this is part of the projections, balance sheet, income statement, tax returns if you're a current business. How far back do you go? Typically 2 to 3 years is the standard that they're going to ask you for.
We ask for 3 typically.
Mm-hmm. Can you put this together on your own? Yes. But again, make sure if you're doing that you truly understand what the numbers mean. Otherwise, certainly reach out, to your SCORE counselor. If you're an existing business and you have an accountant that you pay, certainly reach out to your accountant because they're going to understand every little thing in there. So preparing them, it's critical. There is software available to help you do that. I believe SCORE has access to some models that will help you put together those projections. And again, the cash flow projection, very important because that's what they're going to use to determine whether or not you can pay back what you're borrowing. So at this point, we'll kind of recap and review a little bit of what the lender is going to need as part of that business plan. Typically, there'll be an introduction or cover letter, summary of your financial need, the financial statements or tax returns, 3 years, projected cash flow. If you're an existing business, 1 year. If you're a startup business, 3 years. Whatever you're going to need, whatever you're financing, make sure you understand what is available for collateral, both on the business side and on your personal side. You will need to provide personal tax returns as well. They'll have you fill out a personal financial statement and then a resume, what your experience is in what it is that you're looking to do.
And I will say that one of the packets out there is a checklist that Vermont Community Loan Fund has of things we look for in a business plan. In practice, if you're working with SCORE or another organization like it, your plan is going to easily touch on all of those points that we're looking for, at least in regards to the narrative and then the financial projections.
And just kind of a word on that, I was doing a panel similar to this yesterday, and I had 4 other lenders with me. And 3 of the 4 lenders said, if you're working with SBDC, SCORE, or Center for Women in Enterprise, that they know that business plan that they're getting is good quality product, and they know it's been well thought out. So they already, without even looking at it, knowing it's coming from one of those organizations, they already know that it's light years ahead of something that somebody just walks in and it hasn't been reviewed or vetted by a counselor. And it puts you higher up on the priority list for them to want to provide the financing.
Totally agree with all of that.
So tips for achieving credit readiness. You know, I would say think like a lender. You know, if it was your money, you know, what would you want to know, right? What is it that you want to know if you're going to lend your money? It's kind of the same scenario for the lender. You know, they're going to ask lots of questions. Good preparation is key. Knowing and understanding what's in that business plan is very critical. So it brings me towards the end of the presentation, but I kind of have some action steps that I recommend that you kind of follow through before looking for the financing. So the first thing that I can't recommend enough is meet with a business counselor. You know, it's just going to set you up long term. Have the business plan, know what your business can afford, understand what it is you're looking to finance, know what the purpose of your loan is, do a reality check. You know, those projections that you're providing the lender, they got to be realistic, they got to be attainable, they got to be considered viable, and you need to understand those financials because they're going to ask you questions about them. Check your credit report. Gather any documents that you need, purchase and sales agreements, lease agreements, cost estimates. You know, if you're looking to purchase equipment, you can very easily get, you know, an invoice. Document what your equity contribution is, and then meet with the lender. So at this point, it kind of brings me to the section where I don't know if folks picked up this piece. Did you put them in? Okay, so this is on the SBA's website, and this was put out there to combat kind of the predatory lending that was happening online. SBA did a lot of research and found that after hours, weekends, our website was getting the most traffic during those times. And they realized while we don't do any direct lending, a lot of folks were coming to our website saying, it's the SBA, you know, I can get a loan from the SBA. So they developed this thing called Lender Match, and I've got the link down there. And basically what it is, very, very briefly, you answer a few questions. It takes you like 5 minutes. The lenders, we have a whole host of lenders in Vermont. Vermont Community Loan Fund is on this list. They take that information that you enter in and the questions that you answer, and I think it's 20 questions that you answer. They'll get an email saying, this person's looking for financing. Here's their contact information. They have the option to opt in and get that information, or they can just opt out. We have a whole boatload of lenders in Vermont that are on this Lender Match system. They will call you because, again, they're not making money unless they're lending money. And then they'll work with you. So if there are certain things that you need to put together, they're going to refer you back to counselors and say, you know, these are the things I'm going to need. So on the back, and again, this is right from our website. Again, it kind of does that get ready, you know, the things that you kind of need to have. So I encourage don't go to one of those online lenders and pay, 18, 19, 20% interest. If you don't want to sit down with, a local lender, or you don't know where to start, I have business cards here. SCORE counselors are all in the room. We can certainly find lenders that are willing to lend to you. Reach out, use Lender Match. Again, a lot of the banks, credit unions, all the mission-focused lenders in the state are on this. We don't want you paying, 18, 19, 20%. So I think at this point, Dan's just going to give a brief overview or a couple words on Vermont Community Loan Fund.
Sure. So Vermont Community Loan Fund, we are a community development financial institution. We're based in Montpelier. We lend all over the state of Vermont, however. We kind of lend on a three-legged stool. One leg of the stool is small businesses, another is child care centers, and then another is affordable housing developers and community facilities. We're looking for people who may not be able to qualify for a loan from a traditional lender. I will always be the first to admit a bank is always going to beat us on interest rate. But if for some reason you aren't able to get a loan from a conventional lender because you're a startup or because you've had some potentially adverse credit history, we can take a look and see if it's something we can do. We do not do any personal loans or loans for residential mortgages. We're not licensed to do that, and that's not a product we offer. What is our application process? I put our direct line on the packet. You can call us. Rather than have people just send applications in to us, we'd like to have a conversation first, learn about your business, learn what you're trying to do, how long you've been doing it, or if you're just starting it up, who you've been working with on it, and try to understand your story and see if it's something that can potentially make sense for us to work with you on. In terms of measurables on working landscape, the ones we are typically looking to see, because we'll ask people to send in or report to us every year about how their things are going and what measurables you're hitting. And for working landscape, we're looking to see acres of land being put under management and use. One thing we've noticed is with the disappearance of a lot of the smaller scale dairy farms, people are coming in and trying to finding new ways and new products to repurpose that land and put it back into use. So that's something we're definitely interested in. And also, how many pounds of locally produced food are you putting out there into the system for people to try to purchase? Maximum loan size cannot exceed $350,000. We can do loans much smaller than that. Like I've said, I've done loans this year as small as $5,000, $10,000.
So we want to thank both Kevin and Dan for giving us an overview of what it really takes to get a loan and an idea. At this time, we have about 10 minutes. We can take questions. Anybody have any questions, or are you overloaded?
All right, going back to when we were talking about FICO credit scores, can you give me some examples of negative events that might result in no way to get to no? Get to yes, excuse me.
Find a way to get. So, like I said, most common things we've seen: someone had medical bills. That's very common. We can try to understand. Was that a one-time event? What happened there? If there's been adverse events in the family past, like a divorce or deaths in the family that often lead to job loss, that can have impacted someone's score. So we'll need to understand what happened there. And then also, if there's one thing we look for is not just the credit score, but how much debt there is relative to what your income has been to that point, just to see if someone has gotten to a point where they've been potentially overextended or had to take on too much debt. It is important to note for things like student loans, those can often, particularly if they're federal student loans, you can qualify for an income-based repayment program or some kind of deferment as well, potentially, depending on your individual situation.
And there is a lender that they help with credit repair. There is a credit union that specifically focuses on that. They have a specific program that helps people that have troubled credit.
Yeah, we have seen those credit builder loans, they're
Yeah.
called.
Yep.
Yeah.
Another question?
In a ag type of business,
Yep.
we're looking at a long 3-year term before we actually see a serious turnaround in income. The investment that we have already made personally, how well does that weigh on a decision for putting it, I mean, the capital that we have already incurred in this to acquire plants and so forth that really can't be itemized as a value? Do you look at that as a value in your mind, or what? I mean,
Good question. In general, when talking about money someone's already put into the business, it's seen as a positive. It shows the commitment to the business. It shows that you're trying to execute a long-term plan. The one caveat I will offer is if we see people are pouring money into a business and just racking up debt on credit cards to cover losses, and there doesn't seem to be a plan or to get back to profitability, that would be a concern. But in terms of if people are put their own money into startup equipment, fixtures, that sort of thing, I would see that as a positive.
but the key thing that I hear you say there is, startup equipment and fixtures. I'm talking more of, okay, so let's say I went out and planted 10,000 apple trees. You can't really sell those apple trees.
No, that's an investment in infrastructure. I'd give it the same. I'd
Okay,
give it the
all right,
same.
so
That's a positive. Yeah.
Okay,
Yeah.
all right.
Yeah, you had to pay for it somehow, right?
Right,
So
but
it
you
came
get-
out of your pocket, so that's your money going into the business, so that's your equity.
Yeah.
But but it can't be really used as collateral, though.
No, it can,
Oh, it can?
yeah.
If it's increased the value of the land potentially, if
Okay.
there's now
All right.
the potential
Okay, all
income
right.
producing asset on it, certainly.
Okay.
Dan, you mentioned that you have typically higher interest rates than typical banks.
Yep.
By what amount? 1%, 2%? Because why would I end up wanting to go to you if I can go somewhere else?
Well, if a bank can give you a better rate, I'll be the first person to say you should go to the bank. Or in terms of what our rates are right now for an agriculture or food, farm, and forestry-based business, it's about 5.25%. For a conventional small business, it's 7.25%. And so, can you walk into, if you can go over there to NEFCU and get a loan with them, then and do what's right for your business by all means. But we're targeting people who aren't able to get that conventional loan. In terms of our size of our small business portfolio, just to give you some context, I think right now we have a little between 6 and 7 million in outstanding small business loans. So compared to big banks, we're not nearly the size they are. So.
And it's risk-based, that's why.
Yeah.
That's why the interest
Yeah.
rates are higher.
Yeah.
It's based on risk. They're taking on a little bit more risk than, because the bank doesn't want it. I will say, there are times where banks and credit unions will partner with Vermont Community Loan Fund. Steve Greenfield, one of the SCORE counselors, used to work for VITA, which is a quasi-state agency. Similar, they partner up with the banks and credit unions, and they will take a piece of that financing package. So in today's world, it's very common that you might not be at one place obtaining all of your financing.
So when you're looking at collateral, I'm sorry, I'm at step one. But when you're looking at collateral, what's the percentage of collateral to the actual loan? So say you needed $100,000, what percentage of that collateral needs to be financed?
So probably the standard probably would be 80% would be able to be financed. So they'd be looking for you to have 20% cash, so 20,000 in.
Yeah. I will say if we're talking about a smaller loan for $5,000 to $10,000, that's something we can overlook at that scale. But
Same question, but if my projections indicate that I'll need 29,000, what would be the percentage on that? 60 or so, 80?
it depends on the underlying collateral, what it is. If we're talking about inventory, we typically have to mark that down more to secure it versus, equipment, depends on the equipment, it can hold its value a little better. And of course, land holds its value best of all.
Yeah, because it doesn't depreciate in any way, shape, or form.
Well, yeah, assuming it's being properly maintained and cared for, entropy affects us all, so. Yeah.